Welcome to the Morrows Private Wealth Half-Yearly Update. This update highlights the key messages for you to take out of the detailed written investment report that we've recently prepared for you. Today, we'll take a look back at what happened in the 2019 financial year, discuss where we are in the economic cycle heading into 2020, and provide an overview of our portfolio strategy and asset class positioning. In the December 2018 quarter, the US market declined 20%, briefly falling into bear market territory, before 2019 saw a strong rebound across all asset classes. This chart shows that the 2019 financial year witnessed the quickest and sharpest market decline, noted by the red circle, followed by the quickest and sharpest market recovery, noted by the green circle, during the current economic expansion, which is now the longest economic expansion in history. The volatility that we witnessed in the 2019 financial year is typical of late cycle market behaviour, whereby sentiment swings between expectations for global growth and fears around a slowdown and eventual recession. Where we are in the economic cycle is important because the stage of the economic cycle can assist us to make asset allocation decisions that will impact future investment returns. In our previous half-yearly update, we indicated the cycle was moving towards economy slows, enters recession phase. 6 months later, and we have moved further into this phase, with some indicators such as subdued inflation and falling bond yields suggesting that recession may not be that far away. This phase of the cycle warrants a more cautious approach rather than being in full risk-on mode. July 2019 marked the 121st month of this current economic expansion, making it the longest in history, going back to 1854. That said, the New York Fed's recession indicator has recently popped above 30% likelihood of a recession in 2020. Whenever it goes up to 30%, it has a good history of calling a recession, but the lead time varies. This is important because share markets are 6 to 12 months forward looking and historically peak prior to a recession. Markets are relying on central banks to be able to avoid recession and prolong the current cycle. The US Federal Reserve cut interest rates by 25 basis points in July, the first cut in a decade, and now the market is looking for further rate cuts from the Fed this year. In Australia, the RBA has already cut interest rates twice to a new record low of 1%. The RBA may also need to cut rates by another 50 basis points this year, taking the cash rate down to 0.5%. Ultimately, if the global economy slows further, the cash rate in Australia could fall to 0% into 2020. The view of the bond markets is that this record-long economic expansion is fading and that the next recession is getting closer and closer. Despite this change in cycle phase, equity market valuations are still at historical highs, with the bulls arguing that record low interest rate environment is conducive to much higher equity market valuations. One of these views is wrong, so let's explore this a little further. This table shows that in July the US share market was trading in the 94th to 99th percentile of expensive markets dating back to 1871 across a broad composite of measures. Shown another way, the chart on the left highlights that today we have the second highest P/E ratio ever for the US market behind the 2000 tech boom. Even when adjusting for today's low interest rates, the reality is that valuations have never been this expensive for how low the US 10-year bond yield is today. This can be seen by the red dot in the chart on the right. Whilst the tech boom leading into 2000 was a lot more expensive than today's market, it was also supported by much higher growth and stronger economic fundamentals. The question that investors need to ask is, should I stay invested in an already expensive and risky market and hope that it continues to rise, or do I put in place a strategy to protect capital, acknowledging that returns will be foregone should markets continue to rise further from here? Fear of missing out will keep most investors in the market. Our cycle and valuation analysis, particularly in the US and Australia, suggests that equity markets are very stretched and pricing in perfection. This chart shows that the market could fall by minus 53% if it was to mean revert back to the long-term historical average. Equity investors need to ask the question, given where we are in the economic cycle, how much higher can equities rise from here? Whilst equity investors face their own challenges, bond markets see the onset of a recession and lower earnings per share growth. And this has seen bond yields fall to record lows in recent weeks. Bond investors therefore need to ask the question, given how low current bond yields are, how much further can they fall from here? When we consider the bond question, we think that yields can still go lower from current levels, given that central banks have only just started cutting interest rates, and yields historically do not bottom at this phase of the cycle. This means that low and lower interest rates are here to stay, at least in the short to medium term, and this will be good for high quality government bonds. That said, markets are sensing Japanification, particularly in Europe. The chart on the left shows that Japan's interest rates have fallen for 3 decades, and the rest of the world appears to be following on a laggard basis. The chart on the right shows that there are now more than $15 trillion of global bonds trading with a negative yield, and more than $30 trillion with a real negative yield. A decade ago, the thought of negative interest rates was laughed at. What is stopping the US or even Australia from having negative interest rates into the next economic downturn? And will we see quantitative easing in Australia? The harsh reality is that current valuations and where we are in the economic cycle mean that returns going forward will almost certainly be lower. Let's explore this further. Interest rates and yields have fallen for the last 3 decades and are currently at a record low, likely heading even lower. Lower interest rates equals lower returns on the defensive part of your portfolio. This means that the growth part of your portfolio needs to work even harder to generate returns. But growth assets such as shares and property are already historically expensive. In our view, this means that future portfolio returns are going to be lower. This view is also shared by many others, including BCA Research, who in this table have forecast returns from a traditional US balanced portfolio to be around 3.3% per annum for the next 10 years. This is significantly below what investors are used to and below the future returns that investors are expecting. The current environment arguably remains one of the most challenging ever in which to construct portfolios and have confidence in their ability to deliver returns that meet investor objectives and expectations. What do we mean by this? Well, investors really have a choice when setting risk and return objectives. They can either increase the ranges of risks that they're prepared to take to achieve their target return, or they can accept a lower return for the amount of risk that they're willing to take. So what options do investors have? We recommend that clients adopt a combination of options 3 and 6 for the following reasons. Option 1 is unrealistic given high starting valuations mean that future returns are likely to be lower. Option 2 is not desirable as traditional diversified portfolios are unlikely to meet your return objectives. Option 4 guarantees a return between 0 and 2% per annum and requires you to time the market exit and re-entry. And option 5 will work up until it doesn't. Then your capital is exposed to significant downside risk. Option 3 suggests reducing risk and accepting lower returns. But if you combine this with option 6 and invest your cash into special niches such as alternative assets and absolute return strategies, then you can reduce market risk but not necessarily have to accept lower returns over the cycle. As we experience the longest bull market in history, considerations of what may come next are front of mind for investors. This table shows the impacts of each bear market from the Great Depression to the GFC. The average US share market decline across each of these 9 equity bear markets was minus 44%. This is why it is important to focus on risk mitigation strategies now. Can you stomach a minus 44% loss of capital? Lastly, I'll discuss how portfolios and asset allocation should be positioned given current valuations and where we are in the economic cycle. We expect cash rates in Australia to fall below 1%, and therefore this asset class only has value from a capital preservation perspective. Our currency exposure is neutral to unhedged based on our view that the Aussie dollar is subject to downside risk and that the RBA will pursue a more aggressive interest rate cutting policy. Despite the large decline in government bond yields, we believe that these have further to fall, and therefore government bonds will still provide investors with protection during a recessionary environment, noting that this will be a short to medium term tactical strategy. Credit market risk is high given historically low spreads, high leverage and lower credit quality. We are underweight to credit and need to see spreads widen before we would reallocate to this sector. We have exposure to listed property and infrastructure sectors via our long-short equity funds, but do not want a direct allocation given the late cycle phase and how these securities correlate with shares in risk-off markets. We don't have any exposure to Australian or global long-only beta strategies, given market valuations and the lack of downside risk protection. We have a neutral exposure to Australian and global equity absolute return strategies, given their mandates have the potential to generate strong risk-adjusted returns in all market environments. Liquid alternative assets such as managed futures will be retained given their low correlation with traditional asset classes. Private equity will be retained given its low correlation to listed markets and ability to provide solid returns should markets continue rising, but also to minimise drawdown should markets fall. Illiquid alternative assets such as private equity, private debt, infrastructure and direct property will be reviewed opportunistically. Investors must be prepared to lock up capital to access these strategies, but in our view, there is generally an illiquidity premium to justify the lockup. We hope that you found this update informative and we thank you for listening in. Please read the detailed written investment report that we've prepared for you, as this will provide more context around the issues that we've discussed today. And please contact your advisor if you would like to discuss your portfolio in more detail. Thank you.